Welcome to today's webinar on the results of the Global Recovery Monitor. Thank you for joining us from your offices, living rooms, kitchen tables, or wherever else you might be today. We have a lot of interesting findings to cover this afternoon, so let's get right to it. Our presenters today are Craig Jeffries, Founder and Managing Partner of Strategic Treasurer, Nadia Corbett, FX Specialist at Cantox, and Chad Wekelo, Principal at Actualize Consulting. Welcome, Craig, Nadia, and Chad. I will now turn it over to you.
Thank you, Kai. Welcome, everyone. Thanks for joining us this afternoon. I also want to express our thanks as a coalition for you taking the time today, and also to other coalition partners, Nadia and Chad. So thank you to Actualize Consulting and Cantox. Let me go through a couple things for how we can connect during the webinar and later. If you look on the right, as Kai had mentioned, you can go take the Global Recovery Monitor survey there, and on the Treasury Coalition page, you can connect to any of the companies or any of the people through that link, as well as there's some other information there about downloading the recovery information. During today's session, you can connect to us through the chat box, put any questions you have in there, and we'll try to answer them in context or at the end. And then finally, we have some polling questions. We have 3 polling questions, which will slide over onto the screen to see what the results are from live, real-time polling questions from the audience today. So again, thank you for your time, and let's get into it. So you can see from here a number of slides, a number of companies represented in the Treasury Coalition, representing technology, consulting, and even associations. So they've been participating to help the industry. And when we look at the industry, what's the purpose of doing a monitor or a regular survey? We have taken the mindset of it's useful to do a debrief or a post-mortem after an event of disruption has occurred and then figure out what has happened to help in future events. But we also thought it'd be useful to gauge information almost real time, people's attitudes, perspectives, changes, actions, what they're learning and what they're seeing, so that we can, as an industry, improve and learn during this particular crisis or disruption, as well as gain insights into future items, future activities. So with that, you'll see a typical headline like this with a quote, a nautical theme that talks about, riding out stormy weather or being a good sailor to help guide us through that process. And so you'll see that circulate and cycle from time to time. But with that, we do appreciate everyone who has taken the monitor, and I'd like to bring Nadia into the discussion to describe the response.
Great. Thanks so much for that, Craig. It's certainly a very exciting project to be involved in, and what we're seeing here is the pretty remarkable range of data that's being collected. So obviously that's in terms both of geographical spread and industry profiles, which is going to allow us to already develop real insight into how the situation is developing. To run through the figures here, we've received over 1,600 responses. So thanks for that. Thanks for those of you who already responded. Well over 50% of these are from large companies with an annual revenue exceeding 500 million. We've got 50+ industries represented, and what you're seeing in the percentages on the map are the proportion of respondents who have operations in each location. So again, a very solid coverage across the board, and particularly in North America, where I see a lot of people are dialing in from today. So with that context, let's look at some of the results from the period. Okay, you can obviously feel free to read this in your own time. The slides will be sent out later, but what I want to look at is just some of the key elements that we can pick out here. So we're going to start with a really high-level perspective of the trends that we're seeing in the data, and obviously we will dig into individual elements in more depth as we go on. But given the circumstances, I think it makes sense to start with the health issues. Now these are still looking pretty long. We've taken into account a number of indicators, but if we start with the inflection point for now, we've seen it come down slightly to just over 4 months from 5 months. But when we bear in mind that we're a month out from the last period, this actually remains pretty cautious. There was a bit more optimism across some of the financial and commercial indicators. You can see the liquidity in the health kind of section, for example. Liquidity had been running an 8-period streak of positivity, which ended in period 13, but that's now rebounded in period 14. In fact, period 13 did see quite a lot of negativity across the board, but this period 14 has seen a tendency towards more positivity from a business perspective, if not the health perspective. An interesting aspect of this is actually that we've seen a big return to participants starting or resuming new projects. It's definitely exciting to see things beginning to move there for businesses, and it will be great to follow how this develops in the coming months. In terms of top risks, these were kind of centralized primarily around counterparty and cyber fraud risk, but we did see quite a big change as well in accounts receivable to kind of almost neutral, which I understand doesn't sound kind of confidently optimistic, but after a long period of negativity, it is interesting to note that development. Chad, is there anything else that you kind of like to highlight at that stage, or if you're happy to move on?
No, I'm good. You did a great job.
Thanks. Yeah, do you want to continue with things? We've got a poll question now.
Yeah, so the poll question, you can probably read it on your screen. If you can't see it or you can't respond to it, come out of full screen mode. It depends on your browser whether it can see it or not. Go ahead and click in any of the circles. That will register it. If you wish to change it, just click another circle. There's no submission. This is just a way of selecting it. So as you go ahead and pick, either you've taken the monitor once, twice or more, not yet, but please go ahead and do that, and I'll ask Nadja comment on the results in just a moment. But one thing, too, just to note as we looked at the periods, we've been using the term periods because the first 8 weeks of the monitor, it was a weekly cycle. Then we had another 8 weeks, so 4 cycles of 2 weeks at a time, and now we're on a monthly cycle. So we're just over half a year into the monitor. And with that, let's go and look and see what the results are. I'm sorry, I think, Chad, I think you're going to comment on these results. So sorry, I think I said Nadja.
Yep, so what we're seeing here is that, and I think this has been pretty consistent with previous webinars, is people are very interested in to understand the other people's input, but have not necessarily made time to complete the surveys themselves. And I think obviously a big component of this is making sure that we have a broad ranking of people participating in this so that we can make sure all views are covered. So hopefully if you find this webinar interesting that you're participating in, you'll go ahead and take the couple minutes, 5 minutes or so to take the survey in the future, especially now, as Craig mentioned, that it is going to be more of a less frequent, but I think it'll be a bigger impact on seeing the trends over time, and the more data we have, the more statistically significant it will be and the more value everyone will get out of it.
Great, thanks. So we'll close out that survey, and then we'll move on to the first forced ranking chart.
Okay, so what this is showing you is across these various questions and inquiries, what the various highest to lowest rankings of these are, and you can see the trend, as Craig mentioned, across the various periods. As the periods have changed, then we have a longer period of time to view. And really, I mean, I think if you look at this, you should see it sort of coincides with some of what is happening in either largely with COVID or with some economic components or even certain time horizons of what is happening. So if we look more on the right-hand side, which is more the current periods, what you'll see is we sort of have within the safety protocols some fluctuations between that. It's still in the top 3, but you really notice as it starts to get higher, and what I tend to think about there is I think we see some of our clients going back into the office, or some of our peers going back into the office. And so as people that becomes more of a reality, as well as people's children going back to school as well. I think those two sort of are coinciding in some areas. Then it becomes more of a concern to people because it becomes more real, and then people are starting to see the impact of that. So I think that one, as people go back into the office here over the next month, we've seen some announcements from some very large companies, such as JP Morgan, that they're expecting their staff to be back in the office later in September, as well as other companies. I think this will continue to be a high ranking until, well, in my opinion, for the foreseeable future, unless we get some drastic changes in the health environment. And then from a liquidity perspective, financial impact, that is also remaining quite high, from both what it will be, this have an impact on the business, as well as do we have adequate liquidity to maintain our business, are quite high as well. And as you can see, the financial impact has been consistently high throughout, and same with the access to liquidity, anywhere from first to third throughout. So those two have maintained that very high ranking before. Maybe been some good news if you look at the bottom as far as opportunities for a recession or concern with recession. That was quite high, and that is now reduced. So hopefully people feel the worst is behind them. Okay, so moving on. The next slide is talking about more of a period-over-period sentiment, or how people are viewing from a positive to negative, with the above 5 being positive trend. And so what you can see here across the various components is that we're all of the indicators are trending up. There was a slight dip in the third and second to last and third to last periods, which sort of coincided with the second wave, so to speak, of COVID, or the presumed second wave, where we had a spike in some regions. So there was a period where people were feeling more positive across these various indicators, and then there was some additional concern. In my view, largely seems to be potentially largely contributed to a spike or a wave, and then as some of that is dissipated, we see a more positive trend upward in these various metrics across both the organization, company level, country level, family level, and what your actual responses of your companies are. And in all of these, we have a very positive trend upward, and hopefully we'll see that trend continue as we have some stability.
Yeah, thanks, Chad. And it is encouraging to see some of those numbers, and related to the perspectives on your organization, family, et cetera. But this chart here now touches on different areas of access to capital or liquidity. Let me explain this chart. For those of you who have been reading the charts, you've seen how we're trying to show a massive amount of data. We already have 14 periods of data that we're comparing to itself, so it's very quickly captured data. So we've changed the layout. I'll just explain how it looks now as opposed to what it looked like before. This is a net positive or negative. So if there was 30% of firms that had a positive view about what occurred with liquidity for, let's say, central bank liquidity over the prior period, and 10% had a negative view, the 30 minus 10 would be 20% positive, so net positive, and assuming the other 60% would have been neutral. So we've changed how we're showing it to just show the net difference now that we've gotten farther, and some of the numbers are a little more stable from period to period. In the beginning, there was quite a bit of turmoil as no one knew what was going on and how it would act. I just want to point out a couple things. So if you look at the blue line, it looks like it starts just after period 5 on the bottom. That's accounts receivable. That was the most negative. Well, it's been the most negative through the life of the monitor. In the beginning, the net negative was well below 30%. We had some weeks we had like more than 10 times the number of companies negative as positive throughout throughout the period. So you just see that emerging for period 6, falling within the 30% negative. So that was hyper negative through most of the time frame. Yet it's almost reached neutral. In other words, the prior period, 14, didn't really deteriorate much from 13, which is doesn't mean that it's great, but it means it stopped the descent. I'll just point out one other element. When we look at central bank liquidity, you can see that the net numbers, moving positive, heavily positive, and then generally positive through the time. That's been very consistently positive throughout the life of the monitor. I'll leave the other elements like covenant requirements or bank line of credit. As you can see, some of the volatility over time, conditioned based upon individual creditors, or whether you're issuing commercial paper or not. But you can see how some of these things have moved around a bit. A pretty big negative dip that coincided with some of the negative views on the health situation happened in period 13. So summertime challenges were also reflected on the debt and liquidity side. But this is interesting to see how this moves over time, and so we'll continue to run this on a week-over-week basis. The only one that wasn't run, that we didn't run in week 1 or period 1, was the bank line of credit. That picked up on week 2, just for those that are tracking numbers and wondering why that starts there. So let's move to our second polling question, and this one has a lot of answers. And we'll go ahead and let you respond to it. So you can click in any of the squares that are initiatives that you have over the next year. Now you'll notice that we ask questions about projects started, stopped, altered, or changed. And so this is reflective of trying to gauge more information on what's occurring. But you'll see some of the results from the monitor there. But this is one where you can click in any or all of the boxes where you have initiatives that might touch on these different areas over the next year. So select any that apply. And if you're in full screen and it doesn't let you select those squares, just go ahead and exit out, vote, take the poll, and then you can go back to full screen and you'll be good. So Nadja, you're going to be up for making comments on here, but as we look at the initiatives over the next year, we see probably 3 of them standing out, it looks like. Yeah, go ahead and any comments on what you see here?
Yeah, absolutely. So obviously, I think forecasting and working capital optimization, we should certainly be drawing together. One is integral to the other, and as in any situation where the future is so unclear, it's going to be vital that people are at least comfortable with their internal systems for making that as easy as possible. So trying to get the best possible sense in order to, basically respond to the situation as it goes on, which I think is probably what everyone here today is doing. So certainly those are the 2 that are coming across most heavily. I'm not sure if there's any element of that because they're the first 2, so I don't know if everyone has had time to kind of look down. It is interesting that some people have responded that they really don't plan to change any initiatives over the coming year. So it's going to be good to see how that kind of progresses. At the moment, it does seem though that there are lots and lots of projects which people are bearing in mind, and obviously that's consistent with what we talked about there in the highlights, that people are starting to think about, okay, if this is going to be our new normal, how do we adapt and how do we put ourselves in the best position? What processes do we need to optimize in order to give ourselves the best chance as the economy and each individual company recovers from this crisis?
Yeah, thanks, Nadja. I guess I would just say one thing too in terms of the responses to the poll questions. If you're listening and you're interested in seeing these results, we'll obviously share the slide deck. But if you want the poll question results, we'll share it with the entire group. If we have at least 8 or 10 people in the chat box, write the word poll or send me the polls. If we get 10, we'll send it to everybody just in case there's interest there. But thanks everybody for taking this poll. We'll slide that off, and then Nudge, I think there's some more timing estimates about medical, mortality, end of health issues to discuss.
Yeah, absolutely. So as we said before, people essentially remained cautious on some of the expectation of the timing for these health issues. So we need to look at exactly what we mean by that, obviously. Before I go into too much analysis of the individual graphs, I just want to explain how they're designed because there is a lot of information captured here. Also, I do want to highlight that the graph in the middle, the peak death rate, is a new indicator for this period. So we can't actually see any trends here at the moment, but it's certainly going to be an interesting indicator to keep an eye on going forward, if a little morbid potentially. So the first thing I want to highlight, of course, Craig has already mentioned this, is that not all periods are the same length. So initially the survey was run on a weekly basis, then biweekly, and now monthly. So the earlier periods are much shorter and closer together. So that does skew things a little, and it's definitely worth bearing in mind. The teardrop icons, which label each period, either point left or right. Left means it's pulled back from the prior period, right means it moved further out. Now these icons indicate the median response for the indicator, whereas the bars in blue, gold, and green show the proportion of respondents within that bracket. So with that in mind, the kind of mechanics of these graphics, let's look at the inflection point to start with. We see that earlier on during the crisis, the median responses were all gathered in about a 1 month range, and that was happening at around 2 months. After this time, people thought the impact of the virus would begin to diminish. For period 13 and period 14, that's been pulled way out to sit within the 4 to 6 month range, with some people not anticipating the turn to happen anytime in the next 12 months. So really, a big change there from earlier estimations. The proportions for the peak death rate are fairly similar, although there is slightly heavier weighting within the 1 month bracket, so that does pull the median back a bit. The end of the health issue, though, is much, much further out. So although the median sits within 10 to 12 months, in line with the last period, we see that more people believe that we won't see the end of the crisis within a year, and that's more responses than for any other bracket. The median does sit in almost exactly the same position as the last period, but again, it is important to remember that we are 1 month down the line, so actually in some ways this does represent a delay. And now, obviously the thing that kind of brings us all together here today, since we aren't doctors, is the economic implications of this health crisis and of these health expectations. So if we just move down here, what we're seeing, and actually for those of you who've joined before, you may notice that we've adjusted slightly the ordering here, and we've stacked two graphs together now to give you a snapshot of the economic view. So we're seeing the perception of individual company recovery, and we're comparing that to the economic turning point across a couple of time domains to get a sense of what participants are expecting in the coming months, the coming years. Having said that we're going to compare these two graphs, I do want to briefly look back and point out that the financial normacy graphic, so that first one indicating the perspective on individual companies' anticipated recovery, really, really mirrors the end of health issue timeline almost exactly. So again, we're seeing that there are more responses for the 12-month bracket than for any other bracket. We're seeing the median sitting between 10 and 12 months, again in the same position as P13, but with that month which has elapsed that of course does represent a bit of an extension. When we look at the outlook for the overall economy though, things are looking a little bit more positive. Here we see the outlook for 3 months in gold and for 12 months in blue. Now, it is great to see a gentle upward trend here in both time domains, particularly after that little tumble that we saw in the last period, coinciding with the uptick in health concern over the summer. The scale on the y-axis is a kind of positivity temperature check. So hopefully that can help you to understand exactly what we're seeing. 5 would be about neutral. So 5 would indicate that things are back to a normal pre-COVID level. The 3-month expectation is coming out just below 5, so a little worse than normal, but the 12-month expectation sits up above 5, suggesting recovery. And if we extrapolate these numbers, we're going to locate a return to normalcy at around 6 months. Now, obviously, this is considerably more positive than the expectation of financial normalcy from a company perspective, and I don't want to speculate too wildly about what this says about our kind of confidence levels, but certainly it's an interesting discrepancy, and I think it's, I'm certainly keen to see how that develops over time. So with that said, I'm going to hand back over to Chad, who's going to take us through some of the points of concern which might impact these expectations now in the coming months.
Yeah, so if we didn't have enough to worry about, we have some non-health crisis items that are creeping up here into our purview that are increasing on the graph. So as you can see here, the COVID, both the response as well as, well, there's one change here I guess we should highlight as a starting point. As you can see here in yellow, the COVID, its currently death rate was previously number 1 in the last period, but I think it was partly due to the change in the categorization and the way the questions were worded. So previously it was the health impact of COVID as opposed to the death rate. So while people are still probably concerned from a health perspective, I guess they're less concerned from the impact of it being fatal on the individuals. I think the interesting thing here is that we have items that are creeping up on the upward trend as we get closer to the election cycle. At least here in North America, we have a presidential election, and then there's been other elections throughout the world as well that have already occurred. But the amount of potential discord as well as unrest and potential conflict that is being generated from the political spectrum is definitely increasing here. And with that, I think a lot of people would attribute some of that even to what we have here in orange on number 3 with some of the civil unrest and some of the negativity that's going through. So unfortunately, in addition to what we have from the health crisis, we also have quite a bit of instability in some of the potential political climate as well that's creeping up here as well. And while some of the concerns around or the natural disasters or the trade conflicts are dissipating from people's concerns. Okay. And then next item here, we have another poll question. Craig?
Yeah, we do. And this one is, thanks, Chad. This one is a free-form question. And so when you think about, you can type in your response. What's your greatest concern today? So there's a range of options you could put there. We'd like to keep it short, maybe a word or a couple words. We will come up with a word cloud for this afterwards. We have we will show a word cloud of what are the top concerns we've asked at each period during the monitor, and we'll show you some of those results now. But we'll just give everybody a few moments to type in what's their top concern, across the board. And while people are responding, typing those things in, there's another question. It looks like we have enough to send out the poll responses, so thanks for your interest in that. Andrew asked, could we forward the link to, or you can forward the link to a personal device if the firewall does not intervene. Or you can type it in. I think if you go to treasurycoalition.com, you can click on the link to take it. So that's another way to take the monitor each period. We'll wait, give some more people time to answer those items, the option of your greatest concern today. It's pretty interesting to see these things come around, and we'll share a word cloud afterwards. So thanks for taking the time to type that in. All right, so we're going to go ahead and slide that off now, and we'll continue with the word cloud response, Jen.
Yeah, so I get to make my own word cloud, huh, for this one. So I guess just to, from my perspective and what I see and what we're seeing with some of our clients on some of the concerns here, I mean, you can see obviously economic impact and the impact on the economy. The recession is some of the larger things, but what I'm starting to see and getting concerned about personally is really the intermingling of the health crisis, the economic impact, as well as the political spectrum, and how they're sort of blurring lines. And some of the things that, let's just take the vaccination, for example, is becoming very political, and there's other motives that are being taken into place. The stimulus, the potential stimulus package being held up for very political reasons that is really impacting people. So I think that intermingling of all those components that are having I would say, double negative effect on individuals in the economy as well as just personally is really a concern for me from what I see and is what's coming up here in our future, as opposed to hopefully some more positive things coming out. I think there's going to be uncertainty until we can get some finality on some of these open items. Okay, I'll hand it off.
Yeah, so so this one, we talk about a revenue level dip in the industry. So earlier, Nadja had talked about the company response. So we talked about financial normalcy, which is related to an individual company. And then a little bit later on, we looked at the economic response, or on the same slide, we looked at the overall economy, which was the 3-month and the 12-month time domains. So we looked at those. The individual company sat around 6 months. The overall economy, we were looking at about 11 months. And when we look at this one, it shows a period that's probably somewhere in the 6-month time frame, maybe a little bit longer, but we're measuring by quarter. But let me explain this chart. So this is a period over period, so quarter over quarter. What's your outlook for what's happening? Q3, you could see over half expect it to, a revenue dip in their industry. Only 13% expected some type of recovery. And if we remember, Q2 was, we had a 2-week run-up at the end of March, at the end of Q1, and then we started in a giant hole in Q2. The lost month of April, and then May, May had some improvements over there, but was not what the standard was, and we've seen some improvement from there, but you still see pretty substantial negativity for Q3, which ends in 2 weeks from now. So this was taken during the middle of the time frame, so it was August to September 2nd, so pretty much the middle section of this quarter, so fairly negative. But look on the right-hand side, we say change from the previous period. We asked about Q3 in the month prior, so that was July to the very beginning of August, and we saw a deterioration of a couple numbers there. So the positive went from 17% down to 13%, so, and then the negative increased from 43% up to 52%. So short-term outlook, it kind of went farther away. Nadja had made some comments about, it looks like it pulled in a little bit, but a whole month has elapsed, so it's still keeping some distance in front of us. So Q3 is still quite a negative outlook from the respondents. So we look at Q4 and see what's happened. Well, that's also turned more negative. So the 29% positive from the prior period, looking at that now has dropped down to 25%, and the negative 40% has increased to negative 44%, expecting a dip in your industry. So not asking about company specific, but saying what's the impact on our industry. So we're 19 points net negative in Q4. So the quarter that's going to begin in about 2 weeks, the expectation is a lot of industries are going to dip, at least from the response here. Then when we look at it, Q1, it turns slightly positive. We've got a positive 33 versus a negative 29. So that moves us, into that category of possibly it's positive out, 4 to 6 months, or maybe that's really kind of trending neutral, and then we move to a positive territory in Q2. Q2 seems to be quite a bit more positive, as we have a 33% net positive, the 49% expecting their industry revenue to increase at those different levels, across the board, and then we have only 16% expecting a negative result in 2021. So, just interesting to see how the differences between industry, your own company, and the economy can vary despite having hundreds of responses. So with that, this is a little bit sobering, in terms of the global recovery monitor. Maybe this is more of the global crisis monitor aspect of things being a bit challenging. So we need some good news, and Nadja, I'm hoping you can give us some good news on what are some of the encouraging data points that we've been hearing through the respondents.
Yeah, certainly. So obviously, Craig and Chad have been very gentlemanly there in taking some of the more negative parts, and let's, as we say, move on to some of the signs of encouragement that people are looking out for. So we saw that businesses reopening came out on top, and that was consistent with the prior period. And a huge proportion of respondents indicated that this was one of the top 3 encouraging data points for them. That's what they kind of needed to see to get some hope. Improving jobless numbers came out second, and it actually gained on period 13, with 64% of respondents including it in their top 3, compared to only 58% last time. Now, this is particularly significant given that there was a new entrant in the period, and we saw all the other options falling a bit, partly in response to that. So at third place, we have that new entrant for the period, which was reaching the final clinical trial phase for vaccine, and 50% of the respondents included this in their top 3. So what we're seeing there is 2 economic and 1 health indicator coming out of the top 3. That's been pretty consistent, along with what Chad said earlier. It's not that one thing is coming up on top. These are obviously intrinsically tied together. And to continue with the encouraging news, we're going to take a look here at some of the project activity that we're seeing. So this relates to projects involving either banks or tech partners. Now, the question has been included in the survey twice, so here in period 14 and also a few months back in period 6. And the most significant movements that we've seen between those periods are both very positive. So 38% of respondents started a project in this period, up from only 9% in period 6. And only 24% paused a project, compared to 33% in period 6. We also saw that a big proportion of respondents, though 53%, did alter the scope or the pace of a project. And of that group, 79% of these were reprioritizing project elements either up or down. So a bit interesting in terms of that poll question that we were looking at earlier, actually, in terms of what projects people are thinking about. And obviously, there has to be a kind of COVID impact response in that. Some things are going to be more and more important. 9% considered changing the scope or pace of a project, but ultimately didn't. And only 8% actually cancelled a project. So it's definitely promising to see that things are starting to move again a bit for businesses. It kind of seems that in the early days there was obviously a lot of damage control, a lot of crisis planning. But I think what we're seeing here is a little bit of that return to a new normal, even if it's not the old pre-COVID normal that we knew and loved. But businesses are getting on with their operations now, and they're definitely adapting to this ongoing health situation that we're in the midst of. So in light of that, Chad, unfortunately, a little bit more negative news potentially.
Yes, how come I get all the negative news? The bad news here, which I think we've seen, is there have been some winners, but very few winners. So there's been winners in obviously some of the tech, some of the areas where there's more of the remote learning, the online shopping, things such as that. So there have been some winners. Unfortunately, it's a very small percentage of the overall population from a company perspective. I would say the good news is that while companies may not be growing or they may have some economic impact, you can see here that they haven't funneled that through to their employees and they haven't made layoffs at this point in time. Although, unfortunately, coming up close behind is the companies who have made staffing decisions and have had to reduce staff to cope with the impact that has happened due to the health crisis. I think my concern here, and I hope that we're able to balance this, go out a little bit more down to the left, but unfortunately what we're starting to see now is some of the stimulus run out, some of the other components that people had that the government had put in place to try to stem some of these tides. At the moment, I think every country is a little bit different, but some countries have put in place additional stimulus, some have not, and so I guess I think there's still a concern at least from a personal perspective, that unfortunately the end is not necessarily here on the contraction side, and that may be why we're seeing the fairly 43% that there will be contraction, and so that could be potentially yet to come, even if that hasn't occurred to date. Like you said, the good news is the unemployment number has been decreasing or at least staying steady, so hopefully we can stem the tide on any reduction in future staff over the remaining of the year. Okay.
Absolutely, and I suppose as well as we see some businesses reopening, there may be a little bit of counter as well. Although obviously there's a lot of the economic impact that's coming through there. What we're seeing here is a ranking of the top operational financial risks that companies are facing at the moment. Now, I'm just going to quickly run through the order of what we're seeing. We have counterparty risk for customers at first place, then we're looking at data-related cyber fraud, payment-related cyber fraud, counterparty risk for suppliers, and counterparty risk for financial institutions. And then coming in last, we've got interest rate, commodity, and FX volatility. It's really interesting. We did run this question a while back, and FX volatility was much higher up. But what we're seeing now is quite a clear prioritization and division between what we could see as risks driven by external players, whether that is counterparty or fraud risk, and then the three volatility risks coming in last. Now, how this appears to me is that what people are responding to is the level of internal control which can be exercised. So there are pretty definite and robust ways to manage market volatility, whether it's interest rate, commodity, or FX, even when it is exceptionally high, which we've seen. So hopefully what this is illustrating is that now that we are stepping into this new normal, companies are really honing their controls. They're able to mitigate the impact of volatility, which was maybe a bit more of a shock at the beginning of the crisis. And this is allowing them to operate without too much additional risk from these elements. So if you can bear to forgive me for coming back to our nautical metaphor that Craig introduced at the beginning, it's almost like if you're sailing into a storm, you're going to want to ensure that you're in ship shape before to give yourself the best chance. From there, I guess you could navigate the waters the best that you can, but you can't control those external influences. You can only make sure that as a company, you're in the best position, you're doing everything the best you can. I think, again, to kind of come back to that poll question that we saw earlier, and I see quite a few responses of people wanting to see the results of those polls, but where we were seeing that forecasting and that cash flow management was so important to people, we really are seeing this emphasis on planning and on being able to be as well prepared for whatever 2020 continues to throw at us, whatever happens in the next 12 months as we adapt to this new normal. We really are looking at companies accepting that this is going to be a long-term process and that they need to adapt and ensure that their internal controls, their internal systems are supporting them through that volatility. So that's going to bring us quite nicely into some of the key takeaways that we've identified, actually. If we look first at liquidity management, we're seeing that this preparation, this improving and benchmarking of vital security processes needs to be a priority in the months ahead. And that kind of draws on that second point here around adaptation. So we're talking about proactively adjusting to new circumstances. And again, that's particularly because we've seen the very long timelines that companies are anticipating before we return to normalcy. The second category here is engagement with employees. And again, I want to highlight this word intentional. So it's that need to be proactive, that need to plan and to communicate, since a lot of the assumptions that we were able to rely on before may now be looking fairly outdated. And here we're talking both in terms of the health concerns and in terms of the economic concerns. So it's kind of the companies who are able to really proactively engage, proactively manage themselves, that are going to, survive the storm and gain those competitive advantages. In the interest of balance, I'm going to hand back over to Chad to kind of take on the last couple of key takeaways that are outlined here. And of course, if you have anything, Chad, to add to what I've already mentioned, always great to hear.
Okay, yeah, thank you. I think the reporting on key statistics, which is the next measure we have here, it's fairly in line with what we've seen throughout some of the statistics that we had already. So obviously the counterparty risk as well as the uncertainty in your future cash flows and what those models look like, I mean, those are items that we need additional focus on, and what worked previously and using historical numbers is, this is a time of impact, point of inflection, and when you have that, relying on what you've done before is likely not going to suffice. And so we really need to rethink that and figure out what model will work for us going forward. And so as part of that, I think these type of surveys are great too, to see what other people are doing and hopefully give you some ideas you can take away. So hopefully, to the extent that you can make some time to fill out the survey as well, and then come back and see how things are trending period over period as we have these sessions going forward. Hopefully that will inspire you and maybe give you some new insight that you can incorporate into some of your reporting and how you're communicating that to management. Because what we've seen is that the type of questions, the volume of questions that people are getting in the finance and treasury space is just incrementally different, and that's taking up a lot of people's time. And so thinking about that and being proactive and coming up with new metrics to bring to the table will really help not only yourself but your organization as well. And then moving on to the last metric that we have here on employee care. So, it sort of goes hand in hand with the intentional engagement of employees, but really making sure people are in different situations now, and have different impacts, from working from home, being more isolated, having more personal items to deal with, whether it be child care or even care of family members. Really be conscious of that. And I think the word intentional comes across here again. I think it's a great word. Really be intentional in how you interact with people, how you communicate, how you really just relate to people. And I think I think this has come up previously, but hopefully one of the benefits here is that I think people are starting to see people in different lights, different settings, because a lot of people are working remotely, and hopefully that's something that we can carry forward with us and be kinder, gentler, more caring and understanding workforce when we do get back to a little bit more normalcy. But being proactive and reaching out to people, and even if people seem to be okay, just inquiring and see if there's ways that you can help if your situation permits it. Okay.
Yeah. Thanks so much, Chad and Nadja, and to Actualize Consulting and Cantox. Appreciate you guys being in the coalition and sharing a lot of good information. There is the chat box for anybody to put in additional questions that you may have or comments that we can continue the dialogue on. While you're doing that, we'll shift and just leave a couple slides up here where there's an active link to take the survey. You've heard us say that a bunch of times. We really do appreciate it. And I think you'll find that there's value in taking a survey. It does take 5 minutes, maybe 6 minutes, maybe 4, depending on your speed. But as you answer those questions, that some are the same each period, and some alternate or rotate, cycle in or out, or some are just unique. It just takes a moment or two, gives you a chance to think about different elements about your business, about your company, about your fellow worker or your suppliers or access to liquidity that can prove to be useful. We also put out a podcast each time a monitor period is closed, so that's released on a Thursday at noon Eastern, and then reports are available, and you can download the historical reports from the website by going to treasurycoalition.com, which you can see up above. And it looks like we have had enough responses, so we will send out the polls that have come together for this afternoon session. And I suspect the word cloud will probably take both the morning session and the afternoon session to share that. So again, thank you, Nadja, thank you, Chad, and if there's questions that show up, we'll answer them in the next few minutes.
Thank you, everyone, for joining us today, and thank you to all the past respondents of the Global Recovery Monitor for making this research possible. Please spare 5 minutes and take this month's Global Recovery Monitor by clicking the button on your screen. Thanks!